Imagine borrowing money to fix your roof. The lender says, sure, but you must buy materials only from my store, hire only my contractors, and if you can't pay, I'll take control of your house. That's not a loan, that's a trap. Now scale that up to entire nations. Billions of dollars. Decades of debt. Loss of sovereignty over resources, policies, and futures. Welcome to the world of structural adjustment programs, conditional lending, and what economists politely call development finance. But here's what they don't tell you. The system wasn't designed to help developing nations escape poverty. It was designed to keep them dependent. Let me show you exactly how this works. 1944, Bretton Woods, New Hampshire. While World War II still rages, representatives from 44 nations gathered to redesign the global financial system. Two institutions emerge from this conference that will shape the next 80 years of global economics. The International Monetary Fund, the World Bank. The stated mission sounds noble: provide financial stability, fund development projects, help nations recover from crisis, lift the world out of poverty. The reality? Something entirely different. Because buried in the lending agreements, hidden in the conditions, enforced through economic pressure, is a system that transfers wealth from developing nations to wealthy ones. Not through military conquest, through debt. Here's how it begins. A developing nation faces a crisis. Maybe a natural disaster, perhaps falling commodity prices, or rising oil costs. The government needs capital fast. Traditional lenders won't help. Interest rates are too high. Risk is too great. Enter the IMF and World Bank. We'll help you, they say. Here's a loan at favorable rates. All you need to do is agree to some conditions. These conditions are called structural adjustment programs. And this is where the trap snaps shut. The conditions typically include cut government spending, privatize state industries, remove trade barriers, devalue your currency, open your markets to foreign investment. On paper, this sounds like free market capitalism, efficiency, modernization. In practice? It's economic restructuring that benefits foreign corporations and wealthy nations at the expense of local populations. Let's break down what actually happens. Condition 1. Cut government spending. The IMF demands governments reduce budgets. Sounds fiscally responsible, right? But here's what gets cut: healthcare, education, infrastructure, social programs. The very investments that build human capital and long-term prosperity get slashed first. Meanwhile, debt payments to foreign lenders, those are mandatory. They never get cut. So a nation in crisis ends up spending more on interest payments to wealthy institutions than on its own people's health and education. Zambia in the 1990s spent more on debt service than healthcare and education combined. Child mortality increased. School enrollment dropped. The country got poorer while foreign banks got richer. Condition 2. Privatize state assets. Your government-owned industries are inefficient, the lenders say. Sell them to private investors. Let the market work. Sounds reasonable. Except here's what happens. State utilities, telecommunications, mining operations, water systems assets built over decades with public money get sold at fire sale prices, often to foreign corporations. The profits? They flow overseas, not back into the local economy. Bolivia in 1999 privatized its water system as required by World Bank loans. Foreign corporation took control. Water prices tripled overnight. People couldn't afford water. Protests erupted. The government eventually took it back, but years of damage were done. This pattern repeats across continents: Argentina, Ghana, Indonesia, Jamaica. Public wealth becomes private profit. Local control becomes foreign ownership. Condition 3. Remove trade barriers. Open your markets, they demand. Competition will make you stronger. But developing nations compete against industrialized economies with centuries of development, massive subsidies, and technological advantages. It's not competition. It's domination. Malawi was forced to remove grain tariffs. Cheap subsidized corn from wealthy nations flooded the market. Local farmers couldn't compete. Agricultural sector collapsed. The country that once fed itself became dependent on food imports. Paid for with more loans, creating more debt. The cycle continues. Condition 4. Currency devaluation. The IMF often requires nations to devalue their currency. This makes exports cheaper and imports more expensive. Theoretically, This helps balance trade. In reality, import prices spike, food costs more, medicine costs more, fuel costs more. Meanwhile, foreign corporations can buy local resources at bargain prices using strong currencies. It's wealth extraction dressed up as monetary policy. Deeper spending cuts, greater market access for foreign corporations, and the debt grows, and grows, and grows. Sub-Saharan Africa. In 1980, total debt was $60 billion. By 2020, despite paying back $550 billion in principal and interest, the debt stands at $650 billion. They've paid back nearly 10 times the original amount, yet owe more than ever. The mathematics of this system make escape impossible. Let's talk about what economists call resource curse. Many developing nations are rich in natural resources: oil, minerals, diamonds, rare earth elements. You'd think this wealth would benefit their people, but the opposite happens. Here's why. IMF loans often require nations to prioritize resource extraction to generate revenue for debt repayment. Foreign corporations get favorable deals to extract these resources. The profits? Mostly leave the country. The environmental damage? Stays forever. The social disruption destroys communities. Nigeria produces billions in oil revenue. Yet 70% of the population lives in poverty. Because the oil wealth flows to foreign companies and corrupt elites, facilitated by the very loan structures meant to develop the nation. Democratic Republic of Congo, one of the world's poorest countries, sitting on an estimated $24 trillion in mineral wealth. Why the poverty? Because the mining operations, often backed by international financing, extract resources for foreign benefit while leaving environmental devastation and minimal local employment. The loan conditions made this possible. Now let's address the obvious question. Couldn't these nations just refuse the loans? In theory, yes. In practice, no. Because the IMF and World Bank control access to global financial markets. Their approval ratings determine whether other institutions will lend, whether credit ratings stay investment grade, whether foreign investment flows in. Refuse their terms and you're locked out of global finance. Your economy suffocates. It's a gun to the head disguised as a helping hand. But here's what really reveals the system's true nature: conditionality. When wealthy nations face financial crisis, 2008 banking collapse, COVID pandemic, sovereign debt issues, do they face the same harsh conditions? No. The US Federal Reserve printed trillions. No conditions. European Central Bank provided unlimited support. No privatization requirements. Japan ran deficits for decades. No IMF intervention. The rules that supposedly apply to everyone, they only apply to the powerless. When wealthy nations need help, it's called quantitative easing and stimulus. When developing nations need help, it's called bailout and comes with conditions that strip sovereignty. So what's the alternative? Some nations have tried to break free. Malaysia, during the 1997 Asian financial crisis, rejected IMF conditions, implemented capital controls, recovered faster than nations that followed IMF prescriptions. Ecuador in 2008 defaulted on illegitimate debt, renegotiated on their terms, used savings to invest in healthcare and education. Iceland in 2008 let failed banks collapse rather than socialize their losses, prosecuted bankers, recovered while protecting citizens. These exceptions prove the rule. The system works for lenders, not borrowers. Today the conversation is shifting, slowly. Economists increasingly question whether structural adjustment programs actually work. Studies show nations that followed IMF prescriptions experienced slower growth, increased poverty, and greater inequality compared to nations that charted independent paths. New institutions are emerging. The Asian Infrastructure Investment Bank, BRICS New Development Bank, regional financing alternatives that don't carry the same conditions. But the IMF and World Bank still control over $1 trillion in lending, still set terms for global finance, still shape economic policy for dozens of nations. Here's the truth they don't want you to see. The system was never broken. It works exactly as designed. Developing nations provide cheap resources, captive markets, and debt payments. Wealthy nations and their corporations reap the profits. It's not conspiracy. It's structure, not malice. It's incentives. But understanding the system is the first step to changing it. Because once you see how the trap works, you can't unsee it. And once enough people understand, the system loses its invisibility. That's when change becomes possible. The question isn't whether these institutions serve their stated purpose. The evidence answers that. The question is, what comes next? This is Capital Historian Studios. If you believe economic systems should serve people, not control them, share this story. Because the first step to building something better is understanding what's broken.